Good morning, everybody, and welcome to the second in this series of webinars, making a success of introducing a managed account program. In this series, we've tried to draw on the experience of the 8 participants in the IMAP managed account zone from the FAAA. And those 8 organisations really do represent a considerable body of experience of over 20 years in some cases in establishing managed account programs and working with advisors and clients to embed them into better process for advisors. Today, we're going to be joined by Matthew Swieconek from Findex, Julian Lefcovitch from AMP North, and Simon Wu from Quest. And Jaime Johns, again, will be our moderator for the day. But before I hand over to Jaime, let me just remind you that questions are always welcome. And in fact, we had a lot of questions on Monday where we looked at the fundamentals of establishing a managed account program, the basic considerations that you'd want to think about. Today, we're going to be talking about sort of some of the nuts and bolts, the operations and administration. And then on Friday, we're going to be talking with Elston, Lonsec and Milliman about the investment and portfolio management considerations. But before I do hand over to Jaime, let me just remind you of a couple of events that we've got coming up in 2024. A portfolio management conference in Melbourne and Sydney in March will be where portfolio managers and investment managers whose products are integrated into managed account portfolios have a chance to talk about the broader themes that they see in their particular area of expertise or focus. For example, fixed interest, issues of such as recession and inflation, building retirement income portfolios, the sort of geopolitical environment that we're working in, and how that should be accommodated within managed account portfolios. Then in July, Advice in Action is our conference series where we address the issues of the operation of managed account programs in an advisor context, the considerations for advice practices, licensees, individual advisors, and of course the IMAP Awards, where we'll be opening submissions for those in April and the awards themselves will be in August. So we look forward to you joining us in 2024, which now is only a matter of weeks away. But it's my pleasure now to hand over to Jaime Johns to host our session today on the operation and administration of managed account portfolios. Jaime, over to you. Thanks very much.
Thanks, Toby. This is a great session. If any of you are joining us from the Monday as a follow-on session, why this is the perfect complement to Monday is we're now looking under the hood of where these managed accounts sits and what that looks like from a governance perspective, what that looks like in an advice process. If you've done maybe a transaction, you're looking at M&A activity, and also what the governance framework looks like if you're either searching for the right managed account on a platform or you're considering building your own managed account and the considerations that align with the needs of the platform as well. So to kick things off, I might just throw a question out to the man who is associated with the platform right now, Julian. If we look at the interest that we've seen around the managed account space today, and if I was looking at moving to a platform to find the right managed account provider, what would you say I need to sort of be considering to find the right managed account on the platform and how that's appropriate?
Yeah, thanks, Jaime. I think, making the shift to managed accounts is a big shift, and we typically find that advisors and practices, when they are making that shift, they are considering the technology platform that they're using. So these managed accounts do run on different technology platforms. So it's really important that, I guess, that the platform that you're using is one that is easy to do business with and delivers superior client outcomes for the clients that you advise. So in terms of being easy to do business with, you shouldn't just look at the managed account solution. The advisor portal needs to be really efficient. It needs to offer really good reporting functionality. It needs to have a high level of automation and straight through processing. So you don't want to when trades are submitted, you don't want those trades just sitting in a queue for days. There really needs to be a straight through process. In terms of delivering superior client outcomes, I think one really simple way that platforms can help deliver superior client outcomes is offering a solution at that is competitive from a fee perspective. So you've got to consider the fees that are being charged, and one of the ways in which platforms can help really deliver good fee outcomes for clients is around providing things like discounted unit classes. This is an opportunity for platforms and the RE to ultimately negotiate cheaper investment management fees to be used within managed accounts for the benefit of the members that are in the scheme. So you should partner with a platform that has a really aggressive program that seeks to find cheaper investment options on behalf of the members that are using the managed accounts. I think it's really important to managed accounts are a more transparent investment solution, and I think it's really important to be aware of the fees that you're being charged. So look for you don't want there to be hidden transfer fees or managed fund transaction fees. So I think it's important to partner with a platform that has a really transparent fee structure. And then there are certain features that you should be seeking, I think, to help drive better client outcomes. And some of those features, will include things like simultaneous trading. So the ability to buy and sell assets at the same time. So it just minimizes the time that your client will be out of market. A lot of platforms will do this for equities. Only a few will do it for managed funds. And then, other things like fractional units can be really beneficial. What that means is that, a client is invested wholly or fully in the portfolio. They don't have excess money sitting in cash. So that can be really beneficial. Smart trading algorithms are another really important aspect to consider. I personally don't think that I don't think platforms are commodities. I think there are differences between the solutions that are on the market today, and I think it's just really important that you consider the differences and lean on your platforms, lean on your BDM to understand what those differences are. Probably the other point to make is just around technology and the evolution of technology. I think managed accounts exist today because technology has evolved over time. We had technology that could deliver a basket of listed securities. Over the last 5-10 years, we've been able to roll out diversified managed portfolios with different asset types. And that has really driven the growth of managed portfolios or managed accounts. But I think technology will continue to evolve. So it's really important to partner with a platform that has that is committed to continuous innovation. And one really easy way to kind of figure that out is ask your BDM, what does the roadmap look like for your managed account solution in the coming years? What are you developing? And if they can't articulate that well, then it's maybe you need to consider the partnership. So yeah, I think partnering with a platform that will continually invest in its solution and will help future-proof, I think, your practice and your offer going forward.
Some really good points there. Just two I wanted to touch on. One was around the communication. So you made some really strong points around the benefits of how the money's being invested, how it's being held, how it's unitized. Do you think, and we're going to touch on client communication later in the session, but do you feel that we're doing enough to educate our advisors to educate their clients when it comes to that particular area? Because I just feel like some of the points that you've made, we're probably not promoting that enough.
Yeah, and when we sit down with practices and we're talking to them about, you know, transitioning to managed accounts, I think it is a shift, and it's really important, I guess, to invest the time in taking advisors on that journey. First and foremost, I think you've got to get the buy-in from your practice and from your staff, and being able to, you know, communicate the benefits and show them that this is a more efficient and effective solution is really important. Why is that really important? Because these are the, you know, advisors are going to be talking to clients, so they need to buy into the solution first. And you know, there's some great material out there that platforms are producing to help you know, to help you have the conversation with your, you know, with your client base. Again, lean on platforms to help you drive that change.
And to your other, I was going to say, and to your other point around the platform space, as I mentioned in the opening, we've definitely seen this increase in appetite for using managed accounts in portfolios. Have you seen within North, obviously, but the greater platform environment, an increase of exposure to different managed accounts that sit within a platform? Because I know that there are some platforms that hold probably a limited diversification of choice that's on there if someone doesn't want to create their own managed account.
Yeah, so I think that's probably it's a good point, Jamie. And you know, no two practices are the same. So I think ensuring that you partner with a platform that has a flexible offer, I think, is really, really, really important. You know, we work with advisors that don't want to manufacture product. You know, their value proposition is solely focused on delivering, you know, quality advice and the kind of the strategic part of you know, advice. And for those advisors, they kind of want to distance themselves from building portfolios. And so if that's you, then you know, you've got to make sure that you partner with a platform that has a really extensive list of flagship options. You've got to make sure you're partnering with a platform that has choice, both choice of manager and choice of, you know, portfolios. So that's really important for those, you know, advisors that do want to manufacture or do want to build a portfolio from the ground up. You know, typically with an asset consultant or a manager, and for those that, you know, these types of practices have probably got a well-articulated investment philosophy. They may have been running models for many years with an asset consultant. The platform plays a really big role, I guess, in helping bring that solution to life. So, you know, and they do that in a number of ways, right? So the platform could be the RE, and they play a really big role in kind of governance, in assessing the manager and then assessing the portfolios and making sure they're fit for purpose and they're and making sure the portfolios are kind of true to label. They also play a really big role in just manufacturing and bringing that solution to market. They'll look after your disclosure, your TMDs, your fact sheets. Now, you know, you might want a heavily branded solution. So if that's the case, find a partner that offers, you know, branded TMDs and disclosure and fact sheets. That's not for everyone, but for some, that's really important. And then, you know, as I was saying earlier, the platforms and REs play a really big role in negotiating cheaper investment management fees. So make sure that your platform's committed to doing that. It's really important if you're building out building a portfolio from scratch. From a communication perspective, you know,
We
the
won't go too far in there, because we're going to dig deep on governance and comms later in the session.
Sure.
Lee had a question which was around how do advisors get accurate information between the services and the platform. In my experience, Lee, and anyone can jump in here, I've had a lot of advisors who I've been doing consulting work with using a tool called Suitability Hub, which goes in and compares platform to platform a little bit more accurately around services, rather than it just being about cost comparison. So I don't know if that's something that any of you are familiar with, or you've got anything else you want to sort of contribute, but that's been a really great platform tool that I've had advisors using. We might move on to a question with Matt. Now, Monday we covered the SMA versus MDA conversation and the differences, but it would be really great to have, your perspective around this and how that sits from a portfolio construction perspective, and also what the challenges are and can occur when assets and managers are being added to a platform, and how this is handled.
Yeah. Thanks, Jaime. And look, just there might be a bit of overlap here with what was discussed previously. I mean, Julian's got his finger right on the pulse there in terms of, I guess, some of the pressure points that you face when working with a platform, and certainly from our perspective, we're an MDA provider, so we run an MDA, but we also have SMAs that we utilise. So, practically speaking, I guess, look, our investment philosophy, irrespective of which structure or vehicles being used, is the same. We run a certain asset allocation, strategic and a tactical asset allocation. So if you're looking at trying to achieve that asset allocation with the use of SMAs on a platform, obviously you can do that one of a couple of different ways. You can utilise sector-specific SMAs to really build out your asset allocation, or you may wish to utilise multi-asset SMAs, and obviously they're growing in number. They may be a little bit unaligned, let's say, with your house view on asset allocation, because essentially what you're doing is investing into a multi-assets vehicle that is utilising a tactical asset allocation and a strategic asset allocation that is being developed by the investment manager. So I guess that's where we have gone down the path at Findex of utilising an MDA for a lot of our clients, because it does allow us to really embed our own strategic asset allocation and our own tactical asset allocation within our own set of models. Also, if you're wanting to have your own house views embedded in an SMA, for example, and you wish to go down that path of acting as the portfolio manager, there is a fairly costly and probably lengthy exercise that you'll need to go through in terms of working with the platform, as Julian mentioned, maybe for them to act as the RE. You're producing a PDS, then you're having to go through the whole due diligence process to have that included, hopefully, on the platform or a series of platforms, depending upon who you're wanting to partner with. So it can be a costly and time-consuming exercise to do that, and you've got to make sure that you've got the expertise in the background to be able to manage that. But as mentioned, we've elected to primarily utilise an MDA because of the fact that it does allow us to run our own series of models. So we run over 7 different risk profiles, a series of different models. Each one of those has their own strategic and tactical asset allocation. The tactical asset allocation is reviewed on a quarterly basis. We review on a quarterly basis. There's a little bit more involved in that we need to obviously have a license variation to be able to offer an MDA service to our clients. We do need them to sign up to an MDA contract and an investment program, and the investment program really then stipulates the benchmark asset allocation that those clients have and the ranges within which we have discretion to move. And the client signs off on that, and we need to make sure that we are making sure that the clients are remaining suitable for that service at least every 13 months. Within every 13 months, we're needing to generate a piece of advice or an ROI that then and make sure that that still remains suitable for the client. So there is a little bit more work involved for that, but as I said, it does allow us the flexibility that we may not necessarily get with an SMA, and an example of that might be it will allow us to exclude certain sectors for clients that may be managing their own sectors. For example, they might be managing their own Aussie equity portfolio. So within our multi-asset models, we will manage the other asset classes around their Aussie equity sector, or they might have specific holdings within the Aussie equity sector that they may wish to hold on to. You know, they might have 10% of their overall wealth in a series of stocks that they don't wish to sell out of. So we will just reduce our weighting to the Aussie equity component to account for that holding that they have within their portfolio. And then there are other a myriad of reasons as to why we may need to put preferences or holds on certain assets for those clients. So it is quite a flexible arrangement for us. The issue can sometimes be, coming to your point or your question, Jamie, around the addition of some of the investments onto the platforms, because within our MDA environment, clearly, you know, we're wanting to partner with a platform that has a great breadth of investment choice across funds, ETFs, listed securities, and so forth. But it's not always the case that all of the assets that we wish to invest into are held on the platform. So we then need to make sure that we've got a good relationship with the platform. We know what to expect around their governance. We know what research reports, what their template documentation is required that we need to provide to the platforms to actually expedite that process of getting that fund listed onto the APL, so that we can then have that included in our model portfolios.
That's a great lead into the next question for Simon. But I guess once I've sort of asked this about Simon, it would be great to get your additional thoughts, Julian, as well, given you're sitting in the platform space. But if we think about, as an example, Simon, you've got an Aussie equities concentrated SMA, and Julian spoke before about accessibility across platforms and platforms that are making a variety of SMAs available. So you're currently on North, you're on Hub 24, you're on Macquarie, and one I'm familiar with, Mason Stevens. What's driven that selection for you around the platforms to gain that exposure? And if you can kind of talk to the cost of what it looks like in order to gain that exposure, because quite often people are quite quick to go out and run and create their own managed accounts, but you know, it comes at a cost. And also, how do you choose which platform you decided to partner with?
Yeah, I think that's a good question. I mean, a lot of our activity is client driven. So we have clients that, you know, have been supporting those platforms to date, and so naturally that's a good place to build out that offering. You know, as an Aussie equity manager, we're kind of involved in different forms in the managed account space. Like, we run our own direct equity SMAs on various platforms, as you've just mentioned, and we also have unit trusts that are used as building blocks in multi-asset SMAs. And unit trusts, in our experience to date, have been the weapon of choice for those, you know, for that type of managed account. But then also increasingly, you know, we are seeing clients that have a preference for running SMAs within a managed account because their clients want that transparency. So I think it comes down to, you know, solving different needs for different problems. Ultimately, it comes down to what sort of problem is the client trying to solve. And so for us, with the concentrated equity SMA, it's we've actually had quite a few advice firms look at that as a direct equity replacement solution. So I'll provide an example of you know, a firm that we've recently engaged with that's you know, running a very large direct equity book across a fairly sophisticated client base. What they're doing right now is not scalable. You know, it's you know, that there might be different portfolios across different clients. Reporting is a challenge. Half of it's on platform, half of it's off platform. Clients are getting different experiences, they're paying different fees. And so what Quest offers is a professionally managed direct equity replacement solution via our Australian equity SMAs, with robust reporting, with robust governance. In order to get an SMA on a platform, you've got to jump through numerous hoops, such as, attaining investment ratings, satisfying minimum FUM obligations. You need to compile a sufficient track record of achieving your investment objectives. And so what managed accounts bring is increased rigor around the governance and compliance piece. But yeah, in terms of where we place our bets, that's predominantly client driven. Sorry, Jaime, you're on mute.
Sorry, Julian, just to touch on what you mentioned, and Matt and Simon, what should be considered if we have someone who's considering doing their own managed account and let's say want to add it to North, what are some of the considerations for them to think about?
So if they're building a portfolio from scratch and they're building a custom portfolio, from a cost perspective, I mean, we don't charge an upfront cost. I know some platforms do that, but so there's no dollar cost, but there is a fairly heavy investment of time to set this thing up. So it is worth trying to understand whether this is the path. Is this the path that you do want to go down? I think there's a misconception sometimes around kind of retail menus, that they're kind of a bit generic, and but the reality is that the retail menu is often the best ideas, and they contain the flagship products of some of the best managers in the market. So I think it's certainly worth taking a look at the retail menu, trying to understand whether your philosophy aligns with one of those managers in the first instance. And then if you find that you do want that level of control, that you do want a bespoke solution, then you're kind of walking down the bespoke path. Do consider the time that's required to work through the portfolio. Do consider that I guess you are getting closer to product manufacturing as well. And there's some risk involved there, I suppose. But there are some benefits as well, I guess. Yeah.
So, just sorry, Jaime, if I can.
You're right, Matt.
Sorry, just to jump in and add to that, I guess you'd have to ask yourself why you're doing it. If you're able to essentially, as Julian was saying, replicate what you are seeking to achieve with what's already there, why reinvent the wheel? Is it just because you want to go to your client base to say, we have a set of our own managed accounts that are produced by XYZ Financial Planning, so they're bespoke to you and our client base, but you've got to consider the resources that have to go into that. What's your governance framework that sits behind the whole construction of your portfolio? What's your asset allocation approach? Who assists you with that? Have you got external asset consultants that are going to help you with that? And what's that actually going to cost you, as well as your investment committee process, and also the externals that you might want to bring in to remove any conflicts of interest and so forth. There's a whole myriad of different considerations that would have to go in. It's not just constructing a portfolio simply and having it listed on the platform. There's a lot more that goes into it, and it comes with a cost.
Well,
and not necessarily the benefit.
Yeah, well, I got you there, Matt. There was a question around your MDA process. Is that the same for both retail and wholesale clients?
It is, and what I would say is that 98% of our clients would be retail. So irrespective of the fact that we could classify our clients, many of them, as wholesale, it's been our business philosophy to treat all clients as retail. It just makes sense from a operational perspective to do that, so we don't have different sets of processes and documentation and so forth. It just makes it neater for us. That may change going forward, but at this point in time, no. It's primarily retail.
And Simon, would you say there's a question here about more availability of ETFs now? Do you think that's going to change the way managed accounts are offered?
I'm probably not the subject matter expert here, but yeah, certainly I think, more choice is a good thing. We are seeing, there are off-the-shelf managed portfolios, there are advised portfolios, there's private labels, there's managed accounts. In our experience, most of the clients we've engaged with are advised by an asset consultant. And so having additional building blocks to build out multi-asset portfolios, I can only see as a positive. And that, the space continues to evolve. Literally every day there's, different fund managers and coming out of the woodwork and asset consultants and more choice across the board, across each layer of the food chain within this space.
I think it's a great question, and it is something that we'll definitely be covering off on Friday's session. You alluded to a question that we do have, though. This came up on Monday, and I suspect it will come up on Friday as well. The viability of the marketplace. So with the appetite increasing and the variety of different managed account providers out there, whether they're established institutional providers or whether they're directed by an advice firm, do you see that we'll start to see some merging of activity in this space in the future? This is to the whole panel, because to the point that the question sits, that is a significant nightmare for advisors around having to obviously transition portfolios if that merge activity happens, or they need to start changing the portfolio structure.
From my perspective, I guess I only look to the historical situation that we've had with traditional unitised managed funds over the last 20 or 30 years, and I guess I've been saying for a while that we've seen this major proliferation in the volume of managed accounts that are becoming, more and more available, and we don't know about many of them that exist just as yet, because there's not that element of transparency that I guess we've had with the more mature managed fund market. But I think if history does kind of, as they say, rhyme a little bit, so I would expect that there will be amalgamation, consolidation, to get that scale as time moves on, and I get a sense that it will follow the path that we've seen with the traditional, as I said, managed funds space in the last 10 or 20 years or so.
So when the advice firm is actually the portfolio manager, how do you best present them handling best interest, or when a conflict actually sits there around, and I'm not saying conflict is bad as long as it's transparent and disclosed, but how do you manage that best interest piece and managing conflict when it's under the same house?
I guess that one's for me. So
you or even from Julian's perspective, if the platform is the host of even Simon, if the platform is the host of that, or the AFSL perspective, how do we ensure that it's being recommended under best interest duty and that conflict's managed?
I think it's a really important consideration. I mean, the vast majority of practices that we work with do outsource the investment management piece to a consultant or an investment manager, and I think they just agree that's where the expertise sits, and it's one less thing for them to kind of get involved in. It frees up their time. They're able to spend more time on other activities. So it's not something that comes up often, but I think it is, if you are going to go down that path, you need to make sure that your business is structured correctly. And I would probably suggest that sitting down with a legal rep to get some guidance on how to structure your business is really important. And then ensuring that you do have the conflicts will exist. So just ensuring you have appropriate ways to mitigate those conflicts is critical. Matt,
Simon, you'd see a bit of this given your client base and how you're working alongside them, given, as you said, a lot of your work is client directed, being the advice firm.
Yeah, I'm just trying to think of just some practical examples, but I don't think there is a single one that we're involved in where the advice firm is the investment manager. I can think of I think it might be a platform or a subsidiary of a platform that might be an investment manager with one of our mandates, but we're appointed as a sub-advisor. But in all other cases, I believe there's an asset consultant involved or a subject matter expert in that regard that is an external party to the advice firm.
Yep. Okay, great. So Matt, how do you provide guidance when combining managed account with advised assets for a client? Oh, you're on mute.
Yeah, the system told me I was on mute as I started to launch. You'd think after 5 years I'd get the sort of mute and unmute thing right. Look, our default position is always to take a client's entire asset position into consideration. So we go through the full risk profiling process with the client and determine their benchmark asset allocation. In doing that, we'll look at everything they currently have, and clients may not wish to invest their entire wealth with us, but we will take that into consideration, presuming, of course, they will divulge that information to us, because that's not always the case. We know we have a large swathe of clients who will have money invested elsewhere, and they won't necessarily provide us with full transparency. And we just need to work with that and disclose the fact that we can't manage their other assets in a full asset allocation position without that sort of transparency. But we will just manage our models around that in terms of the way that we construct our model portfolios, taking those other assets into consideration, and obviously that will then determine what their portfolio looks like, starting off with their risk profiles. So it really is just trying to take the whole lot into totality when we begin.
I just did it then. I just muted myself. So if we think about M&A activity, so we've seen a lot of that in terms of practice land. I know as a consultant myself, I've been very busy this year helping a multiple amount of advice firms actually either grow through organic growth, but a lot of them through acquisition. I've noticed that from a valuation perspective, where there has been the adoption of managed accounts, it's actually increased the valuation of the business to make it easier in order to transition. What would you say are some of the things that advice firms should be thinking about if they're looking at merging or you're looking at acquisition when it comes to managed accounts?
I think from like if you're selling your business, I agree, Jamie. I think it does make your business more. If you're using managed accounts, you've got that robust investment approach. I think it does make your business more attractive. I mean, think from the buyer's perspective. If the buyer is looking at a business that has 400, say, clients, and all of those clients are invested in different ways, in different portfolios, different assets. It's a really challenging, it'll be a really challenging transition to manage, because you need to have a think about, how those assets are managed for each individual client. So if you have if you're using a managed portfolio for the vast majority of your business, then it's just a much cleaner business, I think. From an acquisition perspective, I mean, firms or practices that do this really, really well, meet with, their new clients, understand the goals and the objectives, and then try and determine whether the managed portfolio is appropriate if they're using managed portfolios within the business. And it's not always appropriate. There might be assets, back to your previous question, that the client holds that they want to hold outside a managed portfolio. Things like term deposits, that don't typically sit well within a managed portfolio. So in that scenario, I think you need to look for a platform that can manage, assets independently. Things like, the auto rebalance functionality that's on platform can really help manage assets that are inside and outside of, a managed portfolio. Things like automatic buy and sell instructions can really help you manage assets that are kind of inside and outside of managed portfolio. But yeah, I certainly agree. I think businesses are more attractive when they have robust, repeatable, scalable, processes and investment solutions in place.
And if I look at it from an acquirer's perspective, so we've acquired a number of businesses over the last 20 or 30 years, and we've adopted the managed accounts program, and I guess the critical component is really capturing the hearts and minds of the advisors and also the clients within that business. You can't expect or assume that it's just going to happen overnight. It's a process that takes time. It's articulating the why. Why are you going down this path? What are the benefits for clients? I mean, the benefits for businesses are well documented. We know all about those, but what are the end benefits that we're trying to achieve for our clients? What do we want to look like as a business? What are the time frames and the milestones we're trying to achieve over a period of time? And then involving the staff in that, because there's people in that with great IP, and you don't want to disregard what's come before. So involving the advisors in that journey, as well as the support staff as well, because there's work involved. If you're coming from an advice situation and there are SOAs, there's implementation, there's communication to clients, there's a whole raft of activity that goes behind that. It doesn't just happen quickly. So you need to make sure that you're properly resourced and you're getting that input from people who are actually doing the work, because it's certainly something that takes a lot longer. We've made some errors, we've made some really good wins in that space, but from experience, if you start from a place of articulating a strong rationale that resonates with people and you involve them in the journey and communicate it well with clients, and you don't expect it's all going to happen in a month, you'll make a great success of it.
Yeah, that's a really good point, Matt. I know some of the firms that I've worked with this year, they've definitely taken a core satellite approach in terms of the portfolio. And there is a question that we have in the chat box around the code of ethics. We had a really great conversation, I think, on Monday that sat around where you have, let's say, a practice where there's a whole portfolio of stock and you need to actually make a transaction against a particular holding. How are you going to prioritize who you're sort of getting in the timeline first, because you don't get consent straight away, and there could be some timing issues, and then suddenly you're running portfolios with significant balance differences and exposure, which then creates additional work. And the advice firms that I've seen definitely taking that core and satellite approach, they're still quite hands-on around portfolio construction. Especially around fitting the satellite funds to complement the client's investment objectives. But the investment philosophy actually is quite strong around how they're using managed accounts then as part of the core of the portfolio. There was an additional question in the chat box, which was around the MDA structure and PI. Obviously, an MDA is a condition on a license. So if you think about PI, it does assess what conditions and advice is provided on that license. So yes, there is a increase generally, you would say. Matt, you can jump in, but in my experience, I've seen an increase of the premium when an MDA is on the license. But my advice to firms is, if it's not on there and they're looking to do a variation on their license, to, aside from getting the advice from the lawyer who's going to help them add that condition and ensure they got the relevant experience, is chat to your broker and get them to get a quote from either your existing insurer or the market before you take that leap, because sometimes using an outsourced MDA might be a better option.
Yeah, I was just going to say that, because a number of insurers will just default exclude the MDA as part of that, and you'll have to apply to have that exclusion lifted. And there's a lot of granular detail that they will, want to understand around how you're contracting with clients, the asset consultants you're using. I guess just very granular detail around your operation from a back office perspective. So that outsourced MDA option may be a better one for you.
Yeah. And Simon, if we think about as you mentioned, you do have a number of managed funds and a number of SMAs, and we've spoken about how that sits across a number of platforms. How do you manage the compliance and the mandate of this compliance ongoing?
Yeah, that's a great question. I think it's something we need to think about, on a client by client basis. I mentioned the due diligence component prior. We're basically at the, we view our relationship with, investment committees and advisors and consultants as a partnership. So ultimately we're all trying to achieve the same goal, which is providing the best outcomes for the end client. And I think it goes without saying that you need to find the right people with the right expertise, the knowledge and experience, and all of those sorts of things. In terms of, a lot of it comes down to, communication. We generally present to investment committees on a formal basis annually. And this can be where we're one of a few Australian equity managers in a model portfolio, but needs from advice firms are evolving, and more recently, we've been asked by one firm if we can engage with them, monthly at their investment committee meeting and provide them with weekly updates in terms of portfolio positioning changes, what we've bought and sold, the rationale for those decisions, and that. That's just showing how quickly the space is evolving and how needs are changing, how clients want more information more quickly. And so we also need to be, more responsive to, letting advisors know, what we've done. For a lot of clients, we provide portfolio reporting and commentary on a monthly basis. But they can generally source other things like daily unit pricing and performance and other things from the platforms, which are generally data fed. And then, on the other side of things, we also send sector reports to some of our clients and consultants quarterly, because they might align their sector exposures a quarter end for multi-asset portfolios, for example. So, generally speaking, a lot of this communication is written, and it's provided at the frequency, as determined by the investment committee, the consultant, the decision makers within the process.
That leads perfectly into the communication chat that we were going to sort of start to close out on. There's so many channels when you think about the managed account space, in terms of, if we're thinking about the platform, the relationship the platform has with the advisor and the end client. The platform could also be having a relationship with the asset manager who's sitting there. Then you've got the advisor having a relationship. There's so many layers here. If we look at the client comms, and we think about the initial conversation, quite often advisors are faced with the pricing. So how the price of the SMA looks on the platform versus maybe they're used to the bundle of equities that they've had. Matt, what's been your experience at that first front end for the advisor facing the client to talk through the benefits of having a managed account in their portfolio?
Interestingly enough, a lot of clients at that outset, so I actually thought that's what you were doing for me anyway, managing your portfolio that way. I didn't realise there was all of this other stuff going on in the background with ROIs and so forth. But in any case, moving from that, for want of a better term, advised scenario, in our experience, to a managed account situation actually ends up being, in many cases, more cost effective for the client, because the work that goes into the portfolio construction and so forth is less manual. So from our perspective, our advice costs would actually end up being more competitive for the client. I guess if they were sitting on HIN and you were managing the portfolio directly and then moving that into an SMA structure, well, then it's all about the value add. Okay, so what is the benefit? What's the best interest duty component that I'm fulfilling here? And that is, I'm providing you with a professionally managed portfolio of assets that I just quite frankly can't do for you at this point in time with all of the other strategic work I'm doing. So I'm outsourcing that to the investment manager who's the expert in this field. So leave it to the investment managers. There's too many investments out there, as we all know, for us as advisors to keep abreast of all of the various options. So it is really a case of having to outsource that to the experts. So I think that can be validated. But obviously there's an element of continual attribution, making sure that you're keeping on top of that to make sure that you are adding value to the client's situation.
And Simon just alluded to, I guess, the frequency that is changing in terms of the information that's being given, the building of the transparency and the portfolio changes. What would you say good looks like in terms of communication if clients want that transparency over what's being traded on the portfolio, and how is that currently being provided? I guess all three of you can probably give good experiences of communication that goes out to advisors versus clients.
Yeah. While I'm off mute, I'll keep on a roll. I guess, again, from our perspective, it's fairly structured. We have our quarterly investment committee meetings. Immediately thereafter, any outcomes from an asset allocation and a portfolio construction perspective are communicated to advisors. We have an all advisor briefing and an advisor note that goes to supplement that. We then write out within the next week and a half to all of our clients to praise them of any asset allocation and portfolio construction changes. So every single quarter there's a rotation of comms that goes. And of course, if we decide to make any changes interim, the same thing will happen. I guess that works well for us. There's a fine line between oversaturation of communication as well, and finding that nice balance that keeps people informed and engaged, but not too much.
Yeah, I mean, we find that where advisors are using managed accounts, they feel much better equipped, I think, to have conversations about the portfolios with the clients. I mean, I think there's an element of there's the portfolio, and they might be using, say, 5 risk-based portfolios in the practice. They understand those portfolios really, really well. Practices that communicate well will typically have structured time in the diary, whether that's monthly or whether it's quarterly, where they'll sit down with the asset consultant or the manager. The manager will explain the changes that they've made throughout the quarter, why they've made those changes. We, as a platform, as an RE, will produce, we produce quarterly fact sheets, or monthly fact sheets, but quarterly fact sheets that have investment commentary within the fact sheet, which can be sent to clients. Again, explaining the changes that have been made, economic outlook. So there's a lot of communication that's available, and I think advisors feel, at least the ones that we work with, feel really well equipped to have quality conversations with clients. So yeah, I think that's one real advantage.
Simon, did you want to add anything extra to what you mentioned before? I know you started to speak about the communication piece.
I think if anything, like what we're seeing in the industry is a good thing. Like investment committees bring rigor to the whole process, and I think I've just seen an improvement across the board in terms of the quality of investment offerings that we're seeing from the advisors that support us. Having an investment committee means you're forced to show up, whether that's every week or every month or every quarter. But advisors have never been more on top of portfolios than they have been, since the rise of managed accounts. I mentioned the governance aspect of each chain, be it at the platform level, the asset consultant, the investment manager. I mean, there's governance at every part of the chain now. Advisors and advice firms are proactively making decisions, whether it's strategic asset allocation or tactical positions, or manager selection, or just rebalancing. But these are active decisions that are being made at the appropriate frequency for that firm. So I think and in terms of the comms, we've probably never had to do more. We certainly need to provide more to asset consultants and investment committees and advisors, but that then arms them with the appropriate ammunition to go and speak to their clients and keep them informed. So by and large, we're doing a lot, but it's a good thing.
Maybe just one other point, just on communication. I think invest the time initially with your clients. Spend the time to articulate the why. Why are we recommending a managed portfolio? How do they operate? How frequently will we communicate to you? Explain the fact that the transparency and what that means. I think practices that lay that foundation early and take the time, and it's not a 10-minute conversation. Spend the time initially. I think that'll pay dividends. I think within the coming months and years, you'll have less queries, less kind of clients calling you up. So yeah, that would be my advice, is just take that time initially to onboard clients.
That's a really great point. Okay, well, that's a wrap with the questions we had online, and also the questions I had for you today. I just wanted to thank the three of you for joining us. I'll hand over to Toby, but the experience that we've been able to gain from this session alone is enormous, and the experience being added. If anyone online actually has any additional questions for either of these gentlemen, they can either contact them directly, or you can filter those questions back through to the IMAP team and they will follow up those answers. But thank you for joining us today, and I'll hand back to Toby.
No, thank you, Jaime, and to Matthew, Julian, and Simon. Thank you very much. I really appreciated listening to this conversation, the sort of the depth of experience that resonates in almost every comment that each of the three of them made. And what you're hearing here is really a great deal of experience wrapped up in a simple 1 hour session. I just want to pick up on one of the points which came up in the chat box. You mentioned on the chat box you mentioned, Jaime, which was a reference to standard 10 in the Code of Ethics. That standard is make sure that the things you set out to do are things that you have competence for. And in fact, managed accounts is exactly that. And and all three of our speakers today talked about the managed account process as a way of harnessing competence in the delivery of advice outcomes for clients, as opposed to relying on the personal expertise and knowledge of a single advisor supplemented by an APL. So I think in many ways, managed accounts do actually speak directly to standard 10 in the Code of Ethics. And of course, standard 2 is the one which says, make sure you act in the best interests of each of your clients. And Jaime, you touched on that point so well, which is that who you're going to start with when you want to make a change, the A's or the Z's, or the people whose review isn't for 12 months, or the people who you've just reviewed, or the people with more money or less money. So managed accounts actually enable you. It's almost the only way you have of addressing that standard in the Code of Ethics. So thank you very much to our three panelists today. On Friday, Jaime will be rejoining us, and we'll have Mark Smith from Elston, Mark Haraki from Lonsec, and Victor Huang from Millermans. And we'll be talking about one of the things which we touched on today, which is the investment decision-making process, making those decisions and articulating them through the managed account. So thanks very much. As Jaime said, if further questions occur to you, or you don't feel that that your question really did get addressed, feel free to email me or support@imap.asn.au, and we'll look forward to you joining us on Friday. Thanks very much.
Thank you.